The stock market is in free fall, and panic is spreading like wildfire. Trillions of dollars are vanishing before our eyes, and investors are scrambling to make sense of what's happening. But here's the shocking truth. This isn't just a crash, it's the start of one of the greatest wealth transfer opportunities of our generation. Today, I'm going to show you why this chaos is happening, which stocks are criminally undervalued, and how you can turn this crisis into your financial breakthrough. What's causing this unprecedented collapse? It all comes down to one man, President Trump, and his explosive new tariff policies. These aren't your average trade restrictions. They're a global economic tsunami. China faces a crushing 34% tariff on top of an existing 20%, while European Union imports are hit with 20%. And Southeast Asia? Brutal rates between 46 and 49%. These tariffs are targeting nearly every major trading partner America has, disrupting supply chains like we've never seen before. Think about it. China and the EU alone accounted for 1/4 of all US imports last year. Every smartphone, every piece of machinery, every electronic component is now significantly more expensive overnight. The result? A ripple effect that's sending shockwaves through global markets. But here's where things get interesting. This chaos isn't random, it's part of a calculated three-phase economic strategy outlined by Trump's administration. First, tariffs were used as negotiation tools to pressure countries into new trade agreements. Now we're in phase 2, reciprocal tariffs designed to level the playing field. And phase 3? Weakening the US dollar without compromising its status as the global reserve currency. Here's the kicker. The so-called reciprocal tariffs don't actually match other countries' existing rates on US goods. Instead, they follow a bizarre formula. The US trade deficit with a country divided by that country's total exports to the US, then divided by 2. For example, with China's $295 billion trade deficit against $439 billion worth of imports, this calculation yields a 34% tariff rate. Confused yet? So are economists worldwide. This isn't the first time we've seen markets crash like this, and history tells us something crucial. Bear markets typically last about 11 months with losses averaging 32%, but they always recover. Research shows it takes around 13 months to hit bottom and another 2 years to fully rebound. That means you don't need perfect timing. You just need patience and strategy. And right now, key indicators are screaming opportunity. The Fear and Greed Index is deep in extreme fear territory, a signal that smart money is starting to buy. The VIX, or fear gauge, has spiked dramatically, a precursor to market bottoms throughout history. So, where should you focus your investments during this chaos? Let me break it down for you. These 4 stocks are massively undervalued right now. First up is Google, or Alphabet, the titan of search and digital advertising. Right now, Google's stock is trading at its lowest price-to-earnings ratio in 2 years, just 18. This isn't because of deteriorating fundamentals, it's because of short-term market pressures. Google continues to dominate search with over 90% market share globally and remains a leader in digital advertising revenue. Despite recent bearish predictions that Alphabet's stock could dip further to $142 due to macroeconomic conditions, Morgan Stanley projects a bullish rebound to $210, a potential upside of 32% from its current price. What's driving this optimism? Google's massive cash reserves, AI investments like Bard and Gemini, and its ability to weather economic storms better than most companies. Next is Meta Platforms, the company behind Facebook, Instagram, and WhatsApp. Meta has been making headlines for its ambitious AI initiatives and partnerships like the UFC collaboration to enhance global fan engagement. Despite recent volatility, Meta's stock dropped 12% last week. It's still a powerhouse with strong fundamentals. Analysts forecast Meta's stock price could reach $761 by the end of 2025, a 30% upside from today's levels, and potentially climb as high as $995 by 2030. This growth is fueled by Meta's ability to increase ad revenue while cutting costs on metaverse-related projects. Its family of apps continues to drive user engagement, and its AI infrastructure positions it as a leader in digital advertising innovation. Third on our list is TSMC, the backbone of the global semiconductor industry and the world's largest chipmaker. Third on our list is TSMC, the backbone of the global semiconductor industry and the world's largest chipmaker. TSMC produces 90% of advanced chips globally, serving clients like Apple, Nvidia, and Qualcomm. Despite concerns over tariffs on foreign chip manufacturers, TSMC has reported record-breaking revenue growth in early 2025, a staggering 43% year-over-year increase in February alone. What makes TSMC so compelling right now? Analysts calculate its fair value at approximately $225 per share, meaning it's currently undervalued by 50% at its trading price of under $150. Additionally, TSMC is investing heavily in U.S. operations with a $165 billion expansion plan that includes new semiconductor plants and packaging facilities. This positions TSMC not just as a global leader, but as a critical player in America's tech infrastructure. And finally, we have Nvidia, the undisputed leader in artificial intelligence and data center technologies. Nvidia's dominance in AI chips has propelled its revenue growth by an astounding 114% year-over-year, with fiscal 2025 revenue reaching $130 billion. Its Blackwell AI supercomputers are revolutionizing industries from cloud computing to autonomous vehicles. Despite recent volatility caused by trade wars and regulatory concerns, Nvidia remains incredibly resilient. Analysts predict Nvidia's stock could climb as high as $521 by the end of 2025, a potential upside of over 70% from current levels. With cash reserves up 66% this year to over $43 billion, Nvidia has the financial strength to continue innovating while expanding its market share. These four stocks, Google, Meta Platforms, TSMC, and Nvidia, aren't just investments. They're opportunities to capitalize on innovation during turbulent times. While others panic sell during market downturns, strategic investors recognize these moments as rare chances to buy quality assets at discounted prices. History proves that bear markets don't destroy wealth. They transfer it to those who act decisively while others hesitate. By focusing on undervalued companies with strong fundamentals like these four tech giants, and monitoring key indicators like market sentiment, you can position yourself for substantial gains when recovery inevitably comes. The market doesn't reward fear, it rewards understanding and action. While others panic sell during downturns, strategic investors recognize these moments as rare opportunities to buy quality assets at discounted prices. Remember Warren Buffett's advice: be fearful when others are greedy and greedy when others are fearful. This isn't just a market crash, it's your opportunity to build wealth that lasts a lifetime. Don't let fear dictate your decisions, let strategy guide you instead. Subscribe now for more insights on how to navigate turbulent markets and turn chaos into opportunity.